Then passive investors aren't going to know the difference. You show the underwriting passive investors, show them, hey man, I'm gonna make you 30% IRR on this deal. I'm gonna make you 15% cash on cash. And the investors are like, oh my gosh, yeah, your underwriting looks legit. Well, yeah, it looks legit, but where are the numbers coming from? Where are those projections coming from? Are they coming from a realistic place? Are they coming from rosy-colored glasses? So, and really, I think that's the difference. It's the difference between good sponsors and syndicators and bad sponsors and syndicators is not the fact that one can underwrite, one can't underwrite. Well, they both can underwrite. It's just a matter of how you look at the numbers. One of them is being realistic and, under promising and over delivering. And one of them is being unrealistic and over promising and under delivering.
As an operator, I know other investors are romanticizing multifamily investing, and I'm looking to learn from other investors' mistakes. I know you are too, and you found the right place. Welcome to Myers Methods Presents Multifamily Missteps. Hey everybody, and welcome to Myers Methods Presents Multifamily Missteps. I'm your host, Jerome, and I've got John Azar with me. John, how are you?
I'm good, man. Thanks for having me.
I'm glad to have you, man. It was pretty cool to have one of the folks on your team reach out via Instagram and say, you got to have John on the show. And I was like, this is a great opportunity. You're buying all over the Southeast, but, I don't want to steal all your thunder. Do me a favor and give the listeners a little bit about your background and what your current focus is.
Yeah. We are owner operators. We are the sponsor, essentially multifamily focused, based here in the Charlotte area. Buying our assets are all over the Southeast, as you just said, anywhere from the Carolinas to Georgia, Tennessee. We own and operate about 6,000 units, and we've transacted in the past 11 or 12 years of our since we started in multifamily, about 8,000 units. We've transacted over 8,000 units, but we are value add in nature. So we are mostly deal with workforce housing, B class, B plus, B minus, some C plus properties, but and we do a value upgrade formula to all our assets. And when we buy and hold for about 4 to 6 years is our average hold time. And during that time, we institute a value add equation into all our assets with some kind of a light to medium lift in all of them. And we try to make some money for our investors and for ourselves, hopefully.
I'm going to go off the script on this interview because you're one of the largest owners that I've talked to so far. How'd you get into the space, and how do you go from whatever deal 0 is or deal 1 is to 6,000 doors?
Yeah, my brother Tony Azar started the company. I mean, this is a family-run business. We have we have my nieces work in the business. They run the property management side, which is Capstone Multifamily Group. That's our property management sister arm. That's who manages all our assets for us on the property management side. My brother Tony started the business in multifamily in 2007, and 2007, 2008, we bought our first asset in Augusta, Georgia, and we kind of just started adding from there. I mean, there's really no shortcut to growth. You just have to kind of bite the whale one bite at a time. You eat the whale one bite at a time. I've always said that. You can't eat the whale in one big chunk. So I've always said that to anybody I talk to is, and you just kind of incrementally start to build up and grow and add more and get your reputation up and going, which is really probably the most important part in this business is reputation. And you start to get your footing underneath you with lenders and investors, and you just keep growing. And at some point in 2013, 2014, I decided to join my brother and take the business to a different level. And at that point, we were approaching about 2,000 units or so, and we knew we wanted to grow the business incrementally a lot and get to the next phase of growth, next inflection point, starting to get more private equity, institutional investors, and so that's what we did. And between then and now, we are now obviously again over 6,000 units, and still growing.
That is just absolutely amazing. To be able to work with family, to be able to kind of start from, I mean, not so. Just what's your your upbringing? Did you grow up really wealthy, or did you guys kind of create this from little or no means?
No, so we're immigrant. We immigrated to the United States from Syria. We my dad sent my brother here, and then he sent my sister, and and then eventually my dad, my mom, and I moved. I'm the youngest in the family, and my dad, mom, and I moved here in the late '80s. No, when we moved to the United States, we had nothing. I mean, we really didn't start out with much. We lived in a C-class apartment complex in Charlotte, North Carolina. It's I had to earn a few bucks here and there to buy myself some nice Z Cavaricci jeans or something like that, and I at the time, a little nice acid wash Jordache. But that was a luxury, man. That was a luxury. That was the high life back then.
I love
So no, man, we didn't have much. I mean, I didn't. My dad couldn't even afford to send me to 4-year college in the beginning. I had to, because we were immigrant, and I didn't really have we didn't have enough money, so we needed to be in-state tuition here in Charlotte. So I worked. I went and worked, with my brother. And then I went to community college in the beginning. And then, after a year or so, I was blessed enough to get into, UNCC, and, somehow or another made it through college, graduated my way through college after, God knows how many drunken nights and a lot of bar backing, a lot of waitering, and, and a lot of hustling jobs, different here and there. Got my first job out of college, and kind of moved all over the country. I lived in Seattle. I lived in California. I lived in Atlanta area for a few months, and then back to Raleigh. And then the company I was working for got sold to a private equity company, and I ended up moving to Boston and getting my MBA from BU, and had a whole life. Built a life over there. Got into investments and finance, and worked on the investment side of the business, and then started the real estate consulting platform in about 2004, 2005 with a couple of partners of mine from Morgan Stanley, and knocked the ball out of the park for a few years until about 2008. Then some little blip happened in 2008, 2009 that you may remember, that that made us all go back and get day jobs after that, and had to rebuild again, all over again. And my brother's the same way. My brother was in the computer business for a long time when he moved here to the United States after graduating college, and computer business went bust in 2000, 2001, 2002, and he had to pretty much remake himself from scratch as well, and kind of rebuild the business twice.
That's really cool, man. Thank you for going into that. So, over these 8,000 doors, I'm sure there's been some things that haven't gone well. Would you be willing to share any of those missteps with me today?
Yeah, man. If you run and operate as many units as we have, and if you've seen as many units as we have, you've uncovered a decent amount of dead bodies, sometimes literally. So, but and yeah, I mean, look, the biggest thing is you uncover the most when you do your good amount of due diligence. I mean, and that is one thing I always tell people is never ever estimate the amount of due diligence you do because due diligence and being realistic and how you underwrite a deal and what numbers you look at in the deal, that's what's going to save your ass in the long run. Now, it's not a guaranteed thing. It won't save you all the time, but it will definitely take a lot of pain off the table for you most of the time. If you run your numbers like everything is going to go to crap, in a couple of years. If you run your numbers like everything's going to go to crap and you can still pay your bills, then you probably are doing okay with your estimates. If you run your numbers like everything's going to be hunky dory and peachy, and you're going to have 99% occupancy and everybody's going to pay their bills, and then you're probably screwing yourself. You're probably not looking at the deal right. Of course, we all like that scenario. We all like to have 99% occupancy and everybody paying their bills, and we all get together and sing kumbaya and and we all make a ton of money. But that's not reality. That doesn't happen that way. Things happen. Excuse my French, shit happens all over the time, all over the place. It's you buy an apartment complex and 2 weeks later, you got a drive-by shooting. That's no fault of your own. That's that will screw up your occupancy. You buy an apartment and a couple of years later something catches on fire and you lose a building. I mean, so if we always look at best case scenarios, we will never account for these worst case scenarios. Because if you always look at best case scenarios, you will always be blindsided to what's going to happen on the dark side of the equation.
So talk to me about the mix, right? Because if you're too doomsday, none of your deals will pencil, right? Because
of course,
you can all of the upside out. And so how do you balance that? I hear a lot of people talking about, hey, we're stress testing this, blah, 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 blah. But how do you decide what's the most likely scenario? And
I mean, look, don't get me wrong. I'm not a doomsday with all our deals. I mean, we don't take the deal and say, oh my God, what's going to happen when there's an Armageddon? I mean, that's not what we, and this market right now that we're living in, this unprecedented time of COVID-19 is a perfect example. None of us have foreseen this. This is unforeseen from everybody and anybody in the industry. This is nothing that we've penciled in. This is nothing that we've stress tested against. Nobody stress tested against some freaking global pandemic. I mean, if you were to ask me, have you stress tested your assets to a global pandemic 6 months ago? I would have said, what, are you kidding me? What do you mean a global pandemic? This ain't no movie. But
everybody on the sideline is so smart right now. They weren't doing anything. There's nothing wrong. And then the people who are actually playing the game, they're like, how do you plan for this? How'd you?
Yeah. You don't, and you don't. But what you do play for is you do stress test, and you stress test to reasonable levels. And when I say reasonable levels is, if you could stand your occupancy to dip to, for us, we stress test to occupancy dipping to the 80s range, 85. If the deal still holds up and we can still pay our bills with 85, 86, 87% occupancy, then we're good. If, we stress test with rent defaults to, let's call it 5, 6, 7% default rate on rents, which, by the way, that got blown up all to hell right now, because that we're way past that as far as default rates concerned. But if you stress test with 6, 7%, and most of the market is stress testing to maybe a 2.5 or 3%, so you're almost double stress testing, then you should be good. I mean, for the most part, in a normal environment, you should be good. As far as default rates concerned, then you stress test of what you can. You also so the two stress tests I just mentioned is one for occupancy, one for defaults on payments, on rent payments. The third stress test you do is you stress test with growth, market growth, what's gonna happen, the exit cap rate. What you go in at a certain cap rate, you're buying the property at, let's call it a 6 cap rate, and you're estimating that you're going to sell it in 4 or 5 years and exit out of it with I don't know, maybe maybe a 6 cap rate, maybe a 6.25 cap rate. Maybe you add another 20 basis points. Say, you know what, maybe market's going to go a little crappier, so I'm going to make it a 640 cap rate. So it's going to worth maybe not as much as I think it's going to be. So you stress test it that way, and if the numbers still come penciling okay with that kind of a cap rate, then great. And you know what? In 4 or 5 years, if you get there and you sell your property at 5.8% cap rate, then my gosh, you just made yourself a boatload of money. And your investors. Everybody's happy. So that's another stress test that we do, and we always add, we always go, probably I would say, whatever everybody else in our market is doing as far as stress testing, we usually add another 20-30% beyond that to stress test the market. Rent growth, for instance, that's another stress test that you do for rent growth. A lot of people, and that's the biggest stress test that people always overestimate. A lot of operators go in with a rosy colored glasses and say, oh yeah, I can take this unit here, man, slap a new countertop, put in a couple of new appliances, I can charge $250 more rent. I'm like, really? Can you really charge $250 more rent with a new countertop and slap some paint on some cabinets, and you think you can get $250 more rent? Are you kidding me? So,
But John, the passive investors believe it.
The passive investors they don't know what the hell they're talking about. So, yeah, I mean, look, you can make the numbers dance however you want them to dance, and that's the biggest thing. So if you take a underwriting, all underwriting is a bunch of numbers that you put together, and you can tweak the formulas around however you want to tweak them. I mean, but if you're not looking at the numbers in a realistic way, if you're saying, well, I'm going to get $250 worth of rent bumps next month, as opposed to, yeah, I may be able to get away with $50 or $40, then passive investors aren't going to know the difference. You show the underwriting passive investors, show them, hey man, I'm going to make you 30% IRR on this deal. I'm going to make you 15% cash on cash. And the investors are like, oh my gosh, yeah, your underwriting looks legit. Well, yeah, it looks legit, but where are the numbers coming from? Where are those projections coming from? Are they coming from a realistic place? Are they coming from rosy colored glasses? So, and really, I think that's the difference. It's the difference between good sponsors and syndicators and bad sponsors and syndicators is not the fact that one can underwrite and one can't underwrite. Well, they both can underwrite. It's just a matter of how you look at the numbers. One of them is being realistic and, under promising and over delivering. And one of them is being unrealistic and over promising and under delivering.
What's up, guys? It's your host, Jerome. I just want to let you know we launched Myers Methods in the fall of 2019 with the ambition to inspire a new breed of multifamily investor. If you are interested in getting into multifamily or scaling your current business, hop over to our website at myersmethods.com to grab your free 4-step guide on how to get the ball rolling in multifamily. Now let's get back to the episode.
Which camp would you like to be in? I don't know about you. I always like to be in the under promise and over deliver. I always under promise and over deliver in everything. So
let's talk a little bit about that, because there are some investors who are looking for, they compare pro formas or offerings, and they pick the one with the highest return, right? Every time. If I'm putting my $50,000 or my $25,000 or $100,000 in this deal, I'm the one that's going to offer me 10 instead of 8.9.
Yeah. Unfortunately, you're right. Yeah. I mean, I can't, unfortunately, I can't proof against lack of knowledge and sometimes ignorance. You can't proof against that. I don't know how I can't always win deals just by the numbers. So if somebody's if an investor's looking at my deal, and it happens all the time, I pass on investors. We pass on investors all the time. I get an investor that says, hey, I'm expecting, I want my deals to have 15, 16%. I'm looking at a deal right now. It's going to give me 16% guaranteed cash on cash every year. I'm like, oh, guaranteed? Really? Oh, I was like, what is he buying? Government bonds? I mean, I don't understand. Where's this guarantee coming from? He's like, well, you know, that's what the numbers they gave me. I'm like, really? Okay. Well, my deal is going to pay 12% or 12 to 15%, you know, and I, I'm not saying I guarantee, but I'm going to tell you that look at my track record for the past 10 years and look at all the investments that we've made and look at all the numbers that we've been able to deliver for the past 10 years. And they are consistent with the numbers I'm telling you. So if you're going to tell me I don't know what I'm talking about against some guy who just started buying his first multifamily or second or third multifamily and is guaranteeing you, quote unquote, 15 to 18% numbers, then, you know, brother, God be with you. You know, go invest with him. You know, I don't, you know, I can't, you know, and then you start digging into the numbers, and that's when you start asking some questions. And I say, okay, so what is he expecting his occupancy to be? What is he expecting his rent bumps to be on that deal? What is he penciling in for that? What is he penciling for that? What is he penciling for that? And once you start talking about the numbers and you start getting a more comprehensive conversation, I can always win a deal. I can always win a deal. But it's people who wants to have blinders on and say, I don't want to hear about the numbers. I'm looking at this pro forma and it gives me the right numbers that I want to look at. And I'm just going to go with the highest numbers. I'm like, okay, great. Go with the highest numbers. You know, it's the same investors that a year later are going to call me and say, man, that deal went belly up. And I'm like, well, no shit. I didn't make no 18%. I'm like, nah, you didn't make no 18%, did you?
So what would you say to somebody that doesn't have a 10-year track record but is looking to present realistic numbers to potential partners or investors? How do they work with the investor in order to get them to participate in the deal?
Just be real and pragmatic on your numbers, man. Just talk to other people. You know, it's a small industry. Talk to other people in the industry. There are a lot of sponsors that are like, I still reach out to sponsors. You know, we reach out to sponsors all the time that are in the same boat as we are. I always like to talk to peers in the industry. There is no competition in this industry. And that's one thing that people sometimes mistake. There's no competition. I'm not competing. I mean, because and that sounds weird because, you know, we say there's no competition because look, man, if you can make the numbers work on the same asset as I'm looking at and I'm scratching my head saying, man, I can't make the numbers work, then God bless you. You know, go take it. It's not a competition. Then you must be doing something that I can't figure out how to do that you're making the numbers work for you. Then go take it. So, you know, I don't believe in competition in this industry. I mean, you can either make the numbers work for yourself or you can't make the numbers work for yourself. And if you can't make the numbers work for yourself, somebody else can make the numbers work for themselves. So, and growth in this industry is knowledge. Growth is just sharing the knowledge. It's not hoarding it. You know, it's not, you know, oh, I know how to underwrite. I'm going to keep the way I look at numbers just me. It's mine. And you can't look at this. I'm not going to share with you how I look at numbers. Well, why not? What, you know, what's, I can tell you I can go through with you right now the way that we underwrite our deals. That doesn't make you overnight that you're going to be able to go out and slam me in the markets that we're buying in. You know, that doesn't mean that all of a sudden you're going to, if you can go overnight just from me explaining our underwriting to you and get 5,000-6,000 units, then my goodness, you must be a genius, you know, or, you know, have, I don't know, Warren Buffett as your backer or something like that. I mean, I don't know how you can do that. So, you know, you got me. So there's no competition. It's sharing knowledge, talking to your peers, you know, comparing notes, seeing where things are, seeing how everybody's looking at the same formula. That's how you get better. That's how you improve. It doesn't happen in isolation. You don't grow and improve and get better in a bubble. Nobody does that. You know, it's, you know, people who are in a bubble, they don't grow, they die.
So did you learn that through experience, or you always knew that just by being collaborative in your approach?
I've always been collaborative in my career in general, whether it's in the stock market, whether it's been, you know, in, you know, my previous work in structured finance, and certainly in multifamily. Multifamily in the past 5 or 6 years have certainly taught me a lot of collaboration skills. I speak at a lot of conferences in commercial real estate, and I see a lot of the same people over and over again every time I go to travel to these conferences. And some of the best insights, some of the best deals, some of the best you know uh, market intelligence that I've gotten have been from peers, from people just like me, from sponsors that are doing exactly the same kind of work, maybe different market, maybe similar market. They have different focus, different investors, but when you get together and talk and exchange knowledge about where you are, how you're looking at things, the world opens up to you. I mean, and it doesn't take anything away from you. It actually adds to you, as opposed to taking anything away from you. So I think the biggest advice I can give is just be open to collaboration, be open to knowledge, share first, and you shall receive later. Don't always expect to receive first before you share. Always share. Always share. At some point or another, it will come back to you.
Wow. That's perfect. Without me even asking the question about words of wisdom, John, I appreciate you coming on the show today.
Of course, man.
If folks want to get in contact with you, what's the best way for them to do that?
You can email me, John, JOHN at maccvp.com, MACCVP.com. You can find me on LinkedIn under Jalal John Azar, or MACC Venture Partners. You can find me on Instagram, or you can go to our website, which is maccvp.com, MACCVP.com.
Awesome, man. Thank you so much, and we'll talk soon.
Thanks, man. I appreciate you having me.
You made it to this juncture, so you really love what we shared on this episode of Myers Methods Presents Multifamily Missteps. Do us a favor. Give us a 5-star rating. Give us a review. And share this with somebody who's interested in multifamily investing. Until the next time, the pack is with you.